the takeoff in China in terms of economic growth started just over 20 years ago, the early 2000s. And the catalyst was China entering the World Trade Organization back then. GDP per capita was quite low at that point in time, but over the next decade, we saw a rapid increase in the economy. Nominal GDP was compounding every year in the mid-teens during that period. And China really emerged at that point in time because it integrated with the global economy. Its size of its economy grew so significantly, and was very reliant on global growth as well. So when the global financial crisis hit, things had to change in China. And a new sort of phase emerged at that point in time where China wanted to keep growing. It felt like it had to keep growing to become a superpower. But how they went about that changed, and we went to an economy now that will rely a lot more on debt to stimulate growth and again increase GDP per capita at high rates, but at slowing rates because the quality of growth started to deteriorate. We are at that stage now where China, I guess that economic model, an investment-led model that was initially started with World Trade Organization and the jobs that were created around that and the industry that was created around that, transitioned to one that the credit had to fuel investment. And we are now at a point where China actually has very high debt to GDP ratios, actually higher than in many developed markets that we know, even though it's an emerging market status. Relative to other emerging markets, its debt to GDP is actually very high. And despite continuing to put credit in the economy, the rate of growth has been slowing. And one of the challenges they've faced is because they've been adding investment, constantly adding investment. When you add investment to an economy, what you're really doing is expanding capacity. And your demand is slowing down because people are getting more indebted. And so you're finding these deflationary forces have been building in China now for some time. And this is the greatest challenge China now faces, and this is what the markets are really worried about, is that China can't keep doing what it's done. The quality of growth has deteriorated, you're at a high level of debt, and what you need to now do is do structural reform to find a new growth driver for the economy. Well, the opportunity for China is around the economy still has very high savings rates. On average, a household saves about 40% of its income. Whereas in the West, and particularly in places like the US, the savings rate is closer to 10%. So the question is, why is the savings rate so high? Because if China can get the savings rate down, you start to increase consumption. So number one thing China needs to do is to become more of a consumer-driven economy, a service-driven economy. But for the time being, households are very reluctant to do that. So you need to, I think, improve the social safety network. People save a lot in China for a rainy day, for healthcare, for education, and even for pensions and retirement. And the government needs to come up with a system that better gives people confidence that down the road, when they do retire, there is the social safety nets there. And that will then lead people to spend more today, and that will drive the economy. So the big opportunity really comes down to what's called hukou reform. And that is the social security network in China that hasn't really changed in a long time, but if it does change, you could get a new growth driver for the economy. Well, I think you just look at what the equity markets are telling you today. There is great fear emerging that without change, and just continuing to do what they've done in the past 10 to 15 years, we're moving into an environment of what's called a debt deflation trap. And that's basically what Japan did in the 90s. It went from a booming economy with rising asset prices to one that went to a slow multi-decade decline, where prices start to fall and therefore the incentive to consume declines and invest declines, set against high levels of debt. And we talk about the lost decades of Japan. Well, China is starting to look a bit like that. And if they do not do reform, if they don't get a new driver in the economy, the overhang of all that debt and too much capacity in the economy is going to create significant problems. I think the reality is China is at that stage of development that most emerging markets actually fail. It's called the middle income trap. And China's GDP per capita sits in that range where most emerging markets actually fail. And the ones that have succeeded are the ones that have actually found new drivers for the economy, particularly around structural reform. So this is what needs to happen for China. If they don't, I think you'll find that they're starting to move into a very similar situation to what Japan did in the 90s. I think structural reform, and again, it's hard to know exactly what that looks like today, but it's something I think you need to focus on, because if they just keep adding stimulus, I think the markets it's worked it out, it's not the solution, and you'll get bigger problems that have already been created, getting created again in the future. So it's structural reform, anything that incentivises the household to increase consumption and reduce savings. I think that is the big opportunity. And I guess I remember back in the early 2000s when the World Trade Organization announcement came. At the time, people were trying to work out, just how big it was, when it would happen, and trying to quantify things. I think most people missed the point that something structurally had shifted, and this was going to be a multi-year process of China growing and integrating. And it was a very, the market multiplied over that period, but I think the initial opportunity was there to see the signs that structural reform was coming. And I suspect something like that is what we're looking for here. You may not know the immediate impact of it, but the change in direction is what will ultimately set off pretty strong returns for the equity market and the economy.